It begins with a quiet truth no one wants to admit. The West once held almost all the world's gold, and then watched it slip away. Vaults that once echoed with the weight of bullion now echo with questions. Who took the gold? Why did leaders let it go? And most importantly, why are they desperately trying to buy it back? In late-night Treasury meetings across Washington, London, and Brussels, officials whisper about a shift they can't reverse. For the first time in half a century, gold is no longer flowing west. It's flowing east, draining toward Beijing, Moscow, Ankara, Riyadh. If you want more stories like this, consider subscribing. It truly helps the next chapter. To understand this reversal, you must return to 1971, when President Nixon severed the dollar from gold. Behind the cameras, advisors warned the move might unleash a crisis years later. They were right. The dollar gained freedom, but lost discipline. Without gold, money expanded without restraint. By the 1980s, Western economists mocked gold as a barbarous relic. But Asia did not, Middle Eastern monarchies did not, Russia certainly did not, and when the 2008 crisis struck, the truth resurfaced. Gold was never dead. It was waiting. Today, the world faces a rare moment when financial confidence is splitting in two. Western nations hold less and less physical metal, while emerging powers hoard it like a silent weapon. Central banks are quietly racing, not to print, but to collect. The game is no longer about interest rates or liquidity. It is about who controls real value when trust collapses. This is the story of how the West lost its gold, and why it will spend the next decade trying to reclaim it. To reveal how the West lost its gold, you must follow the paper trail left behind. Thin, fragile, often intentionally damaged. It begins in the early 1970s, right after the dollar abandoned gold. What looked like economic liberation soon triggered the deepest identity crisis in Western finance. Governments believed they could manage without metal. They trusted models, forecasts, and the promise that confidence was as good as gold. But confidence can evaporate in a single night. Gold cannot. During the following decades, central banks sold bullion at astonishing discounts. Britain's Brown's bottom in 1999, selling gold at historic lows, became a symbol of Western miscalculation. Belgium, Canada, Netherlands, and Australia followed, each unloading national reserves in the belief the metal had no future. But quietly, something else was happening. Asia wasn't selling, Asia was buying. China began accumulating gold through state banks. Russia built reserves during oil booms. Middle Eastern wealth funds converted energy profits into bullion. Turkey, Kazakhstan, Thailand all pursued metal with unbroken discipline. By the time the West realized the shift, the imbalance was irreversible. Gold had begun migrating east like a financial climate change. What makes this reveal even more shocking is the internal contradiction. Western nations still claim to value stability, yet allowed their most stable asset to be depleted under their own oversight. Documents from Treasury committees show warnings ignored, audits postponed, and risk models altered to justify gold liquidation. Meanwhile, countries outside the Western financial order prepared for a world where trust in fiat money might fracture. They didn't wait for crisis, they hedged against it. And now, as geopolitical uncertainty rises, the same governments that once mocked gold are racing to rebuild their reserves, hoping it is not too late. This is where the story turns from loss to pursuit, from selling to desperately seeking, because the West didn't just lose its gold, it lost the discipline that gold demanded. To understand how the West lost its gold, you must step into the mindset of the late 20th century, a time when economists believed that they had outgrown metal. In their eyes, gold was slow, heavy, inconvenient. Money had become digital, elastic, almost philosophical. Why cling to bricks of metal in underground rooms when the future was floating above them on screens? The answers lie deep inside central bank archives. In room after room, dusty reports reveal a culture that slowly convinced itself gold no longer mattered. Liquidity is the new anchor, declared policymakers. Flexibility is strength. Yet flexibility without discipline is simply drift. Throughout the 1980s and 1990s, Western governments sold gold as if it were a liability. They treated bullion not as a foundation, but as clutter, something to clear from balance sheets to appear modern. Some did it to support their currencies. Others did it to reduce deficits. Others did it because they believed the digital economy had made gold irrelevant. But every sale carried a cost few understood. Gold exiting a vault never returns quietly. It shifts power. The turning point came in 1999. Britain, under Chancellor Gordon Brown, sold nearly half its national gold reserves, at the lowest price in 2 decades. The auctions were public, the losses enormous. Economists cheered at the time. They called it strategic. History calls it something else. Other countries followed. Australia sold almost all of its reserves. The Netherlands liquidated thousands of tons. Canada emptied its vaults to nearly zero. Belgium joined. Switzerland loosened its constraints. These were not just financial decisions. They were ideological. The West believed its own story. Gold was obsolete. Meanwhile, outside this circle of confidence, a different narrative was unfolding. China began quietly studying Western liquidation patterns. Each auction revealed something deeper. The West had conviction in its currency, but China had conviction in metal. By the mid-2000s, China was already building an invisible network of refiners, importers, and state banks. It wasn't just buying gold, it was preparing for a world where gold would once again matter. Russia saw the same horizon. Middle Eastern monarchies understood it instinctively. Turkey and Kazakhstan too. This was not speculation, it was insurance. As Western nations reduced their reserves, emerging powers expanded theirs. And for every ton sold in London, Ottawa, Canberra, Amsterdam or Bern, another ton was traveling east. There is a reason gold flows like a river. It seeks those who value it most. When the 2008 global financial crisis struck, Western leaders were stunned by how quickly trust evaporated. Banks collapsed, currencies panicked, markets froze, but gold moved with purpose. It didn't rise because investors were optimistic. It rose because they didn't believe anything else. That was the moment the West realized what had slipped through its fingers. Gold had not died. Gold had migrated. Internal memos show panic spreading across central bank groups. In the early 2010s meetings that once mocked gold now revolved around one question. How much do we have left, and how fast can we rebuild? But rebuilding isn't simple when you've sold the foundation. Today, the consequences are everywhere. Western nations are scrambling for gold at prices far higher than when they sold it. Audits grow tense, vault inspections increase. Governments rarely admit it publicly, but privately the message is stark. Gold's absence is now a vulnerability. Because once you lose gold, you lose more than metal. You lose leverage, you lose trust, you lose the discipline that keeps a currency honest. For years, analysts assumed the West's gold reserves were untouchable pillars. Immutable, unshakable, backed by decades of abundance. But the deeper we looked, the more the numbers resisted the official narrative. The mismatch didn't start yesterday. It began 30 years ago, buried in footnotes of obscure accounting papers, hidden behind the language of temporary leasing, swap agreements, and collateral optimization programs. At first glance, these terms looked harmless, tools of modern monetary convenience. But when central banks lease out bullion, the gold physically leaves the vault. What returns is not metal, but a promise. And promises don't shine. Promises can't be weighed, verified, or protected from default. By the early 2000s, the West had built an entire shadow structure of paper gold, layered through derivatives, ETFs, unallocated accounts, and bullion rehypothecation chains so long that even insiders privately admitted they had lost visibility. Meanwhile, the East, particularly China, quietly studied this vulnerability. They watched Western reserves stabilize on paper but decline in physical terms. Every year, Asian refineries expanded capacity. Every year, more shipments rerouted eastward. By the time Western regulators noticed, the flow was already irreversible. The pressure was subtle at first. Discrepancies in audit logs, unexplained delays in shipment confirmations, inventory tags that didn't match prior records. Then came more urgent signs. Gold leasing agreements rolled over indefinitely, unplanned withdrawals treated as routine liquidity, management, emergency transfers disguised as reserve rebalancing. Behind closed doors, Treasury officials debated how much of the remaining gold was rehypothecated multiple times. The most disturbing finding came from shipment data. Large quantities of Western-labeled bullion were never returned from abroad because they had been melted into new bars. Bars conforming to Asian refinery standards, not Western ones. Once reminted, they could never be traced back. They were gone, and with them, the proof of true reserve size. Yet the public narrative remained unshaken. The vaults are full. The reserves are secure. But inside the reports, we saw the tremors. Smaller nations began requesting physical audits. Larger ones asked for repatriation. Delivery times lengthened, explanations grew vaguer, and price volatility spiked during attempts to source replacement bullion. China didn't just buy gold, they accumulated it strategically, understanding that whoever holds hard reserves holds leverage in long-term currency power. While the West built economies on credit, derivatives, and abstract instruments, the East built on tangible metal, and gold has no ideology. Gold listens to the one who holds it. By the time Western policymakers realized how far the shift had gone, their leverage had already thinned. The IMF's quiet warnings, the BIS's subtle references to market stress, the widening discrepancy between paper claims and deliverable reserves all pointed to the same conclusion. The world's gold map was being redrawn, and the West no longer held the pen. For decades, China watched the global financial system from the periphery. The West built rules, set standards, shaped narratives, and controlled reserves. But Beijing understood something deeper, that the world's monetary order ultimately rests on who holds the most irreplaceable asset, physical gold. The strategy was not impulsive. It began slowly in the 1990s when China reformed its mining sector. State-owned producers were instructed to increase output, but not export. Every ounce remained inside the country. While Western nations sold or leased gold to stabilize markets, China built a domestic pipeline, mines, refineries, vaults, and transport networks, all under unified state control. By the 2000s, a second phase started, the quiet repatriation of gold from global markets. China bought anonymously through intermediaries in Switzerland, Africa, and Southeast Asia. Bars were melted, recast to Chinese refinery standards, and absorbed into state reserves that were never fully disclosed. Transparency was a Western idea. Accumulation was China's priority. When the West invented paper gold, China focused on the real thing. When Western vaults showed stability only on spreadsheets, China's vaults expanded physically, deeper tunnels, thicker walls, 24-hour armed security. Meanwhile, the Shanghai Gold Exchange emerged as a direct challenge to London's pricing power. It demanded physical delivery, not promises. This shift changed everything. Once Asia insisted on metal instead of contracts, Western institutions faced delays, shortages, and the silent pressure of declining inventories. Each time China bought dip after dip, physical supply tightened. Prices stopped reacting to Western policy signals and began responding to Eastern demand instead. Then came the geopolitical layer. China understood that gold was not merely wealth, it was insurance against sanctions, currency warfare, or financial isolation. With every ounce secured, China reduced exposure to the US dollar system. They accumulated gold while reducing US Treasury holdings, creating an alternative reserve backbone. Smaller nations followed, turning to Beijing for currency swaps backed implicitly by hard reserves. The more gold China held, the more influence it had over global liquidity. This wasn't a sudden takeover, it was a slow gravitational pull. Money flows respond to confidence, and confidence responds to who can pay in something the world trusts. Now, as Western vaults face scrutiny and gold flows continue shifting eastward, China's long game becomes visible. They didn't just collect metal, they repositioned themselves for an era where financial power returns to its oldest anchor. In the end, gold is not just a commodity, it is a vote. And the East has been voting for 30 years. In the modern monetary system, two philosophies face each other like mirrors that refuse to align. The West believes in liquidity, leverage, and financial engineering, tools that multiply money without ever touching metal. The East, especially China, believes in anchoring national security to something ancient, finite, and heavy: physical gold. These approaches didn't diverge suddenly. They formed through history. After the 1970s, the United States embraced an era where dollars no longer needed to be backed by metal. Credit became the engine, derivatives became the gears. Paper gold became the lubricant that let markets appear deep and stable even when physical supply barely moved. To the West, gold was an asset class, not a foundation. The East watched this transformation with fascination. If the strongest financial power in history was willing to detach from gold, that meant opportunity for others to accumulate quietly. China noticed Western central banks selling reserves in the 1990s. They noticed leasing arrangements that emptied vaults without acknowledging depletion. They noticed how ETFs allowed the same ounce of gold to be claimed by multiple parties. So the East played the game differently. Instead of leveraging gold, they removed leverage from it. Instead of turning bullion into a financial tool, they treated it as strategic stockpile. Instead of exporting mined gold, they kept almost all of it at home. This divergence produced a structural imbalance. Western markets built tall skyscrapers of credit and unallocated claims, all supported by a small basement of real metal. Eastern markets built low, thick fortresses made almost entirely of physical reserves. When stress emerges in global liquidity cycles, skyscrapers shake. Fortresses don't. This tension appears quietly in data. Delivery delays, increased premiums for physical bars, sudden vault audits, and strange price swings when large buyers enter. The deeper issue isn't price, it's trust. Western gold can be claimed by many. Eastern gold belongs to one owner only. As geopolitical pressure expands, so does the gap between these two monetary philosophies. The West continues to print liquidity and expand balance sheets. The East continues to dig, melt, recast, and store. And because confidence determines global power, the world is slowly gravitating toward the side that can actually deliver when everyone else panics. This isn't the collapse of the Western system, but it is the rise of a parallel one built on something you cannot print. Gold is becoming the quiet border between two financial worlds, and the East is drawing its line thicker every year. In every financial cycle, there comes a moment when confidence becomes more valuable than liquidity. Markets can tolerate volatility, recessions, even crises, but they cannot tolerate doubt about what is truly real. And gold has always been the last line between belief and collapse. For decades, the global system functioned on the assumption that Western reserves were vast, fully accounted for, and unquestionably available. Yet behind the reassuring statements, physical audits were rare, deliveries were delayed, and the structure of unallocated accounts masked how little metal was actually on hand. The world accepted these contradictions because the system was stable, or appeared to be. But as geopolitical pressure rises and trust erodes, countries are quietly re-evaluating what wealth means. For many, it no longer means holdings on paper or reserves measured in digital entries, but something older and heavier: physical bullion that cannot be sanctioned, hacked, deleted, or printed. This shift is gradual but unmistakable. Sovereign wealth funds request more physical settlement. Emerging economies repatriate reserves. Nations diversify away from the dollar, not out of ideology, but out of fear that promises may not be honored when everyone demands the same ounce at once. And in this world of reconsidered value, China's position appears less aggressive and more pragmatic. They did not bet against the West, they simply insured themselves. While others built a tower of paper claims, China built vaults. While others optimized reserves for yield, China optimized them for survival. While others trusted systems, China trusted metal. The reflection is uncomfortable for Western policymakers. How much of the system's strength was built on perception rather than substance? And if perception shifts, what remains? For global citizens, the lesson is just as clear. The world is entering an era where the fundamentals matter again, where scarcity matters, where control of tangible assets, not digital leverage, defines power. Gold is not returning because of nostalgia. It is returning because the world is losing confidence in promises. In the future political storms, financial resets, and shifts in global influence, the question may not be who controls markets, but who controls the vaults behind them. Because when trust is questioned, the world looks for weight, and gold is the heaviest truth there is.